Delinquency across all products was up last quarter. 16% of the market. Today, they're currently at a 9.75% delinquency. These two categories are signaling trouble. Almost 30% of investor loans were actually fraud. No one in mainstream media was talking about that.
What's up, guys? I'm Nobody Special, and we've got Melody Wright is back with us today to talk about a very important topic, the slowly but steadily rising delinquencies in the mortgage business. Melody, how you doing today?
I'm doing great, Jack. How are you doing?
I am doing so well. Thank you for agreeing to record this a second time. I'm going to let you guys in on a little inside joke. We actually recorded this last weekend on our trip to Sachs Realty. Todd Sachs and Travis from Real Estate Mindset, along with Melody and I, we all got together. We made some content, and the audio and the recording between Melody and I was just terrible because it was amateur hour with the GoPro, and I made a mistake with my tripod. It was touching the table. There was this weird tapping noise, and it made the content unusable. So, Melody, I'm sorry for wasting your time, but thank you. This is an important topic, and I appreciate you coming back.
Thank you. And talking to you is never a waste of my time, Jack. So.
Oh, well, thank you. Thank you very much. I appreciate that. So let's get down to this. What we talked about before we were so rudely interrupted by my tech issues was the rising trend of delinquencies in mortgages. And you've got access to this data better than most people. So you've got very unique insights here. And your channel and your Substack are growing very rapidly. You are going to be bigger than all of us very soon. But for now, we are the beneficiary of your insights. So tell us about what you see in the delinquencies rising in the mortgage market.
Yeah, so I'll start with not just what I see, but what's being talked about out there. And so you're seeing a lot of headlines that say, seriously delinquent, the lowest ever, and of course it should be, because we've had all of these government programs. We've had the forbearance, we've had what was called the payment deferral, or in the case of FHA, which is a government program called the partial claim, where you could take all of those forborne payments and put them at the back of your loan in a non-interest bearing lien, meaning that it would just sit back there and you only had to pay it off when you paid off your mortgage or sold your house. And so, of course, we shouldn't be seeing delinquencies. There were also the 40-year modification programs that are out there. So of course we shouldn't see serious delinquent, because the minute you get to that seriously delinquent, you're going to be eligible for some of these programs. So the headline.
Oh, go ahead. We had all of these COVID stimulus measures, the eviction moratoriums, the mortgage forbearance, all the loan reworks, the 40 years. So all of these things drove delinquencies to an not all time, but a historic low. So correct. Your point is we should be down very low right now. Very low,
very low. But what I uncovered is, so I still oversee some client books, and what I started seeing last year is we had a tick up in delinquency in December 2022. But what often happens in mortgage is people will get caught up seasonally in the spring with tax returns, bonus payments, things like that. And that happened for mortgage. It didn't happen for auto, though, by the way. But then we got to about May, and I started seeing these upticks in delinquency, which weren't really being talked about in mainstream media. And there is a provider out there called Black Knight. Anybody that's tracking delinquency, I encourage you to go look at that. And where you could before see delinquency by product, and this is kind of confusing, but that's the type of loan, because, essentially in our mortgage market today, there's very few private loans left anymore. It's backed by Fannie Mae, Freddie Mac, FHA, USDA. And FHA used to be really the first time homeowners loans, and those were targeted, but it's really kind of come off the rails. But anyway, my point is I started looking at these products, and you could see in the FHA product that delinquency was very high. I call it the death cross, because what happens when you go from 30 days to 60 days delinquent, you're making a decision about your credit, because credit gets reported at day 31, and that mortgage delinquency is very impactful to your credit. And so when someone decides that they're going to do that, they're going to let themselves go 31 days delinquent, it is a huge decision in this country. And so we call it the death cross. And this is something, I've just been in the industry for a really long time. That's the way we view it, because if you can keep them from crossing that 31 days, there's just way more incentive to stay in the home, because it's almost like giving up, throwing in the towel, to know that you're going to go from a 750 credit score very quickly down to below 700, So I started seeing that in FHA in particular in May of this year, and started writing about that, talking about it. Black Knight put it in a footnote in their report, that just saying, hey, okay, we're starting to see these upticks in FHMVA, and actually they're at pre-pandemic levels. No one in mainstream media was talking about that. And so that delinquency has kind of continued. And where we are today with FHA, which is about 16% of what's outstanding in mortgages out there. So no small potatoes. And put it this way, we've also doubled that product since 2009. So FHA kind of took the place of what was previously subprime, because they're going to have credit scores of around 580, 620, and oftentimes very low down payment, and even potentially down payment assistance. So 16% of the market today, they're currently at a 9.75% delinquency. So overall, in terms of where we are for mortgage, we're at a 1.71% delinquency right now, which is almost exactly where we were when we went in Q4 of 2006. So that's kind of where we are today, which, should be important, because we very quickly after Q4 2006 started just doubling that delinquency as it hit the subprime, which is a combination of non-traditional products and just lower credit quality borrowers. And so I think people often get subprime confused as like, it was just a bunch of lower credit, but no, the investor loans were a big part of that subprime, which we have today in something called DSCR loans, or debt service coverage ratio loans, that are also called, sorry for all the confusing jargon, but also called non-qualified mortgages. Those make up about 5% of the market today. They were a much bigger portion before. And those are also at 5.1% delinquency. And so you've got significant delinquency at 21% of overall mortgages outstanding. But because this is weighted average credit scores, you've got a lot of higher credit quality borrowers who take out larger loans that are for right now doing way better than these other two sort of categories in the mortgage market. But these two categories are signaling trouble. And, it's contagion. This thing is, it's contagious, because as, essentially taxes and insurance increase, the affordability, the ability to pay your loan back hits everybody. And then as we go into kind of, we're seeing a lot of job loss, a lot of layoffs, things like that. Then your prime borrowers start to get hit as well. And then we're starting to see that uptick. Delinquency across all products was up last quarter. So I know I said a lot there, Jack. But
Yeah, that's a lot to take in.
Yes.
Give the smooth-brained among us a minute to digest all that. So you mentioned Q4 of 06, and the overall delinquency is at 1.71%. All right, so
right.
Very low historically. And as you pointed out in the beginning, they should be, because of all of these federal assistance programs that up until about May of last year, right? That is kind of when those things were in place. And yet delinquencies are at about Q4 of 06. And I'm having flashbacks now to younger, dumber version of Jack. In Q4 of 06, I had just bought my first condo in Q3 of 06. And back in Q4 of 06, I was still checking Zillow every day, watching my Zestimate rise, saying, oh, look how rich I am. And, 2 years later, I wasn't doing that so much anymore. I stopped looking real fast when the housing market crashed.
Right.
So you've got 9.75% delinquencies, though, among FHAs, which is kind of, I don't want to call it the new subprime, but people who might have been considered subprime in 06 are now in that category. Now, how fast is that rate of increase? You said it's rising. Is it slow ticks, or is this thing starting to steepen as it rises?
So it's starting to steepen a little bit, but not so where there's still a lot of government assistance out there, not just in these programs, but actual dollars. So if these folks get into trouble, they can get homeowner assistance funds. Believe it or not, we've still only spent half of those funds from COVID. And I was wondering if perhaps they might claw some of that back, when they were having the debt ceiling debates. But what happens right now is folks go in, they call in at that 31 day, they get all kinds of assistance from their servicer. They're told about programs and including these homeowner assistance funds. So it is definitely increasing, but the rate of change hasn't accelerated too quickly in the government space, but it is accelerating much more quickly in that private non-qualified mortgage space, because those aren't eligible for those government-backed programs.
No. And you mentioned the DSCRs again, which debt service coverage ratio. I'm doing your clapping technique to remember that when you told me, because she had to remind me like 10 times what DSCR stands for when we filmed that the first time. So those are basically the DSCRs. They're investment loans. All right. Mm-hmm. Loans and properties. You're only worried about the income from the property covering the debt service cost if it's an investment, right? If you're living there, it's your rent payment.
That's right.
So those are about 5.1%. Again, not alarming trends. But also, you've also talked about, and on my channel the last time we talked, you mentioned this, there's a lot of loans in the FHA category that you suspect don't belong there, and they actually belong in that DSCR category if people were really being honest on their forms when they apply for those loans. Could you talk a little bit about what's going on there?
Yeah, and it's not just me. The Philly Fed wrote an excellent paper about it that, fraud in mortgage had not stopped post the GFC. In fact, it had accelerated. And what they found is that almost 30% of investor loans were actually fraud. And what is that fraud? So when you use a program like FHA, you have to sign an affidavit that you are going to live in the property for a year. And so you say, this is going to be owner occupied. And that is really critical to your eligibility and kind of what you can get on that loan. And so what we believe, or what the Philly Fed believes, is that almost 30% of what's deemed for investor loans are fraud. And so we're hearing all kinds of cases, even with the VA, for instance. I had a client who went out to Hawaii, talked to some service members there. They were talking about using their VA benefits for Airbnbs. They're not supposed to do it that way. And so, unfortunately, I think that we've seen with the mania that kind of set in around passive income, around short-term rentals, and even long-term rentals. There was a period when everybody just thought, well, long-term rents were just going to keep going through the roof, defying gravity. But people use these loans, lied on their applications. And by the way, they can be prosecuted in several ways, especially those that took out, if they did the COVID forbearance and then did the payment deferral or the partial claim. That's considered a false claims act, because when you get those types of benefits from the government, you are filing a claim, or your servicer files a claim on your behalf. And so people could be prosecuted under the False Claims Act for doing this. And I believe there's probably at least one large lender out there that is probably being investigated right now by the DOJ for doing this at scale knowingly. And I think that we will see these types of things come out over the next several years.
Wow. So people taking advantage of these federal programs, taxpayer dollars or borrowed money, Fed go burr dollars, that were meant to either help veterans find affordable housing or meant to help the disadvantaged attain home ownership through these government programs. And instead, those dollars are going to fund real estate bros and their Airbnbs. And on top of that, some of those you suspect have gone into forbearance and taken advantage of some of those COVID programs. So They don't have to make any payments on these investment properties. Meanwhile, they're renting them out to Airbnbs, just putting cash flow in their pocket. And like always, the taxpayer is on the hook via either taxes or higher inflation from government debt spending. Isn't that amazing how that always works that way?
It is amazing. Yeah, it's kind of like the scene in The Big Short, where they show up and the guy's like, I've been paying my rent. And he says, wait, my landlord took out a mortgage in my dog's name, and it's those types of things where a lot of, and this is so unfortunate, the tenant might be paying their rent, but essentially the investor has walked away and has stopped paying. And with these FHA programs, you can do only 3% down. I mean, that is, for an investor or a fraudster who's doing this at scale, 3% is easy to walk away from. If you've been doing the BRRRR, the buy, the rehab, refinance, and that's what a lot of people did. And their lenders would tell you, hey, why only buy one property when you can buy 10? And so they just kept kind of, using these different types of programs, soliciting family members to help them. I have seen already in my client book some really shady stuff. And that's the stuff that very early on, and this is how it happened last time, those non-traditional products, that subprime as well, those are the ones that start to default first. And then it kind of moves on to your prime borrowers.
So it's a signal, right? I want to clarify here, let's keep the doom in check. All right. We get that
That's
feedback
right.
a lot,
That's right.
that it's just more real estate doom, still historically low as they should be, but they're rising, and they're rising in areas that always show the trouble first. And then there's that alarming trend. The Fed's even drawing attention to it, the trend of outright fraud in borrowing.
Right.
And, you mentioned that the guy in The Big Short, I really liked what they did with that character. He didn't get a lot of attention, that the guy who was paying his rent and the debt was taken out in the dog's name, but they did flash back to him very quickly at the end of the movie. They were living in their car in a parking lot. And I remember the guy scrambling to keep his kid from running into traffic. And at the end of the day, all of these programs, FHA and forbearance and COVID, they were all designed to help people like that to get through a hard time. But in the end, the crooks just lined up at the pig trough and pigged out. And it's going to be that guy who pays the price for it again this time around. We see it all the time.
Yeah. And honestly, I think, Jack, so here's one thing to note about this historical low in delinquency. So for FHA, actually, in 2009 and 2010, that delinquency was around, in 2009, it was around 11.5%. But at the peak delinquency for the overall mortgage, it was at 9.33%. So these are really big numbers at 9.75. But another thing to note is that what has been happening that we don't know the impact. We have no way to track this, but people have been doing these private notes, or what's called sub to or subject to, where they go and they see if a notice of default has been filed at the county, and they will contact these borrowers that are in default, and they'll say, hey, we'll pay your mortgage. We'll also give you your equity or some money if you need it to leave. We'll pay your mortgage. And then what they would do is go find out an investor to kind of pay off the loan for them. And so I think that our delinquencies are also very low, not just because of all these government programs, but you've had this cottage industry kind of spring up to go because home prices were appreciating, right? And so investors would be interested in these delinquent loans because they could easily pay that mortgage, pay it off, get that home price appreciation, take those gains by selling it to an investor. So I actually believe that we have had kind of misleading delinquency statistics for some time, because this is really sort of you can go, there's Facebook's groups out there on this stuff. One that I subscribe to is 12,000 people. There's been conferences, where attendance has been around 400, a standard industry conference, usually attendance is about 1,000 to 3,000. So we don't know we have no idea how big this is, but it is big enough that I think we're going to look back on all of this and realize, oh my, there was distress out there, because there has to be, right, Jack? I mean, we're seeing homelessness increase. Travis and I were just on the road seeing people in their campers, in their cars. So, I think that these delinquency numbers have been misleading over the past couple of years.
Yeah, and the subject to situation is interesting. You touched on that. Correct me if I'm wrong, but the mortgage company, if they find out that you've done that, they can call that mortgage and you are instantly on the hook for paying that principal off that day, pretty much, right? So
yeah, they have a clause and they can accelerate it, and it can be fully due and owing. And because the actual homeowner stays on title until that loan is paid off, they'll come after the former homeowner, not the investor. And that's just terrifying. Makes me sick to my stomach thinking about it, because, essentially they thought they got out okay, but in reality, it's going to ding their credit. They're going to be the ones on the hook. So this is a crazy thing that people are doing. They don't understand kind of how we show possession, how we show legal ownership, and that's possession of the note. And these investors that are doing this don't have possession of the note. The banks do, or the servicer. So that borrower will be on the hook, not the investor, in that example I just talked about.
Wow. So folks, if you're involved in one of these, or if you're in negotiating in one of these, run that by an attorney before you do anything, because it sounds like this is something, if it's widespread enough, could be jamming up the courts for years once the music stops. So no shortage of that going on again in the housing market. Well, Melody, I want to thank you so much for your attention to detail and the granularity in the data. Let me summarize real quick here again. 16% of the market is already at GFC level delinquency percents, although the entirety of the market still being skewed lower by a lot of those COVID programs. And fraud, of course, is once again at an all-time high. Did I get the key points there?
You did. Excellent.
And I memorized DSCR. Thank you so much.
You did. Congratulations.
Oh, folks, look, I highly encourage you check out Melody's YouTube channel. I'm going to put links down in the description, both to her channel, Melody Wright, and to her Substack, which is also very rapidly growing. I'm a subscriber to your Substack as well. It is excellent stuff there. You're a fantastic writer, and your channel's growing really fast. And I think I'm going to be begging you for appearances on your channel one of these days when you are much bigger than me. So good luck and congratulations on your growth. And everybody, until next time, live small and dream big.
Thank you so much.